What's up, everybody? Good morning. What's up, everybody? Good morning. What's up, everybody? Good morning. Markets opening. Top of the doomsday band. Possible rational to the upside. Monthly expirations today. Big day. Starting in 2 or 3 minutes. Everybody make sure you smash the like button while we're waiting here. What's up? Good morning, everybody. All right, everybody. Okay, we changed some of the Discord things last night, so if you don't have access, just let me know. I'll try to get your access back. It's because a lot of you did not sign up for, or you did not tell me sign up for membership, and so I need to give you the roles for your membership. How options expiration typically affects ETFs and indices. You tend to have, if you have surprises, they can be violent, very violent. You'll also see monthly hedge pressure and hedge pressure very close to monthly hedge pressure and price be very close to each other on monthly expiration. And you can end up getting a very, 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 very violent move if there is a break. That's it. Other than that, the expiration itself can be particularly random. There's not a lot of expected volatility as you try to price in, as the market prices in everybody's expectations of where they want to be, right? So surprises, like if you have a very rapid push in the money, one side or the other, can cause a snowball effect. So if you break a hedge pressure or monthly hedge pressure on this day, you don't ignore it. It can get violent. It's great to roll, you guys. Markets live in 2 minutes. If you don't have access to Discord, let me know. You should. We're making sure we got everybody covered. So guys, good morning. The last couple people that are still trying to get into Discord for you. Okay. You know, the master plan of reorganizing the Discord. Finally get some time to do it. All right, let's get ready to go. Smash that like button, everybody. Okay. Oh, gotta make my posts. You guys can get more ready to do this. How y'all doing today? Good morning, good morning, good morning. Hands up, let's go. I need everybody in here. If you can't get in the Discord, I need the emails you sign up with. Here's an example of team jogging. You guys can help me out today if people can't get in. They're all going to ask me at exactly 1 second before market opens. There's only like a handful though. Okay, let's get ready to get the calculations coming through, and then we'll do our run. How y'all doing today? Is everybody in a trade right now? Any kind of trade? Calculation out the door. Let's see what we're getting here today. right, let's go. All right, let's get our monthly hedge coming through here. Let's analyze the pre-market really quick. Okay, so we are inside the rational band on the S&P, so that's good. Market's opening steady there. Nasdaq steady. Russell steady. VIX is outside of triple B. We had that pullback yesterday. This is good. This is good for at least a longer haul. Starting for the month, we could get a very big excursion as people are selling in the monthly, so be very careful today. Let's get back to rockets here, so we'll check the numbers as they're coming through. Okay. SPY 23 and Q50. Yeah, we're getting the data coming through here. SPY 287 QQQ. MHP. Yeah, waiting for the rest of it to come through. There we go, 393. You did a 0 DTE and didn't realize there's a monthly, now you're stuck and it's not looking good. I mean, it's the same as any 0 DTE. You'd be stuck on any one of them. UVXY, so we'll check it really quick. Okay, so UVXY is inside of a kind of a mean reverting area. We are possibly breaking through monthly hedge. Should be just very careful today. And obviously, being monthly options expiration is going to be a bigger potential volatility than we normally see if the market does have an excursion. It's usually more wants to be stable on monthly, as everything's effectively mostly priced in. There shouldn't be surprises, but when there are, they're big. So hit that like button while you're hanging out, if you guys don't mind. Let's get this party started here. You go look at Google today. All right, Google is a very long down. Let's take, I'm just looking right out the door at what we have. Very long down today. You have that downward pressure from hedge pressure to monthly. Sandwich between the two. Any loss of 97.5 plus a strike is usually some really nasty move. Seeing how it's really Home sales today? Yeah, housing numbers today. Let's take a look. That's a big talking point right now, and there are people out there that are saying stuff like housing's gonna crash. And I mean, I was around in the last time housing crashed, and typically crash comes from a bubble. Now, let's say the handful of people that did buy houses at double the appraisal just because they were so desperate to get into a house, they might crash. They might crash. Those couple people. So, you might wonder what I'm drinking. It is a Topo Chico. However, I buy like flavor enhancers for water. That is Topo Chico that is flavored like sugar-free cherry Kool-Aid. Highly tasty. And I just was sitting there today and I was like, I'm not going to drink a Celsius today. Pelosi retired crash. I mean, that is one of the memes going around right now. It's like there goes the liquidity in the stock market, right? Yeah, they're looking into some of the things. Anyway, QQQ today, 287. SPY coming through. Yep. So we're still, what it is it still has yesterday's MHP value. So, especially with Qs. I mean, especially with SPY. Yep. So nothing right now until we get above hedge pressures or any kind of move happens. In a day like today, confirmation is all that I need. I want to get confirmation of something. Okay, we're at hedge pressure right now. Sorry, we're at half gap right now, and resilience is less than 0. Not a buy signal. Not yet. This is not good for the open. Obviously, being on the long side of the market, not the best thing, but I mean, I'm 100 Google calls, right? 110 Google calls as well. Got plenty of time to get there. So I'm dancing with the 100 for a while. As long as we don't get a nasty crash today, that's why I'm eager to get these monthly hedge pressures today, just so I don't get caught in a short squeeze. Is there a long squeeze? I'd like to get caught in a short squeeze. You love the new Rocket Scooter login homepage, the only thing that tells me good morning. Hey, good morning. Good morning to you. I love you, spam. You know I do. You explain what you mean by monthly hedge pressure? Give me a ticker. I'll show it to you. Give me your favorite ticker. No strategy for SPY yet. Everything. Resilience is less than 0. Nothing yet. I'm doing absolutely nothing yet. Let the market settle. It's monthly expiration. You got Oxy? Okay. You guys are here for the first time. Make sure you smash that like button while you're here. Man, our stream's getting bigger and bigger every day. We love you guys. We love y'all checking out. If you've not signed up for the free trial yet, go to our Discord. It is right here in the description below. If you go to the Discord, we will show you what it is we do here. It's one click button. Get on inside there. Here's the link. Oxy. Hey, Oxy's popular. As a matter of fact, speaking of the old schoolers, I was on the a podcast with The Street. I don't know if you guys are on Twitter. Follow us on Twitter. I speak on a lot of podcasts. I'm in a lot of groups and circles that do different shows and stuff. I do one with The Street on it's on Mondays now. It used to be on Wednesdays. And Sarge, if you guys know him, was talking about Transocean. I was getting my dry cleaning done, and it was before I went on my Denver trip. And we were driving around, and Catherine does this new thing where she says, she throws a stock, like a random stock at all of us, and we're supposed to talk about it. And one of them was Transocean, and I made a similar joke. I was like, Transocean. I was like, man, that was the biggest shorted stock back in the last oil crisis. And he's like, oh yeah, I love it. It's great. Some of these plays are good. Transocean was the biggest, RIG was the biggest net short during the oil crisis of any stock out there. Transocean was a big target for a lot of the penny stock folks. Now back then, it's more like $3 or $4 now, I think. But back then, it was a big target because people were starting to realize the power of social media and listening to other people talk about open float and high short interest. So that was a big target. But I made a similar joke. I was like Transocean. I was like, the oil crisis is over. No, he's like, but yeah, he's like, but I know I got it at 2 and it's like at 3 or something. I was like, oh yeah, you did. That's pretty cool. Fix the damn data. I'd love to fix the data. My software is working. Our data providers are the ones that are getting slow. Yeah, we're adjusting. We're on it. Everybody's on it right now. We wake up, we tell them they suck, and then we get back to work. And they're like, we're working on it. We're working on it. Yeah. But it's not, because you still have other tools at your disposal. Liquidity map is one of, 14 things. Plenty of things you can trade with. Let's go through them. Okay. Speaking of Oxy, so what monthly hedge pressure is, right? If you look at what we have on the chart, let me see if I can't find something. Okay, so it doesn't. We don't have any call loss for the example. It's just in put zone right now. But when you see something called liquidity map on top of your Rocket Scooter platform, you will see the bear zone and the bull zone, which is derived from the options data that we get. So by the way, I'm about to go through a little example. You guys are hanging out here waiting. Smash that like button. Por favor. Let's get it up to like 80 today. We get all of this data and we process it and we look for just market maker options in a specific trade. It's a certain type of trade that we do and look for. And it allows us to extract from all the information where dealers are positioned against the market when the market's illiquid. So what that means is that if you're buying and nobody's selling, you have a bank on the other side of your trade, a market maker, and they're the ones that sold to you with options to hedge their position. So we look for their options to reverse engineer your position. So now we know where all the bears are through that philosophy. So Oxy is got bear pressure through here. And hedge pressure is going to be your maximum order flow due to balancing out that risk of those options being sold. So if the market maker has purchased options, there's somebody else that sold it to them, If that's somebody else who's another market maker also zeroing their risk, hedge pressure is going to be the prediction of the highest hedging volume of any price. So as you see, it is razor sharp when it comes to being pivots. They, in a nutshell, are the best pivots you can find. And at the minute the market opens and the minute we get the calculation done, looks like it's unstuck now. Over here, by the way, guys, so you get a little bit more data coming through. The volume that comes through here provides pivot. So hedge pressure has a net flux of more long than short orders, more short than long orders here, and vice versa. Monthly hedge pressure is just based on monthly options, and those expire today. This is based on all the weeklies. So we separate the two of them out. When you have those three different things I mentioned, you have the walls, which are going to show where dealer options are, or real bears and real bulls, or split wherever it is, and then hedging to go with it. You get something called liquidity map. And liquidity map is literally a map to show where buyers and sellers can be. You take the letters at the top, match them with the letters at the bottom, and this is BR and S and U. BR, S, and U, you match at the bottom with what you see at the top. And you see at the bottom, there's a general downward trajectory with a little bit of a possible upside to this blue. So it has this kind of like wants to go up and then come down kind of thing. Market's not looking so bullish today. Everybody can see that. Does that answer your question? You go where there's money to be made. Where's there money to be made? Now, here's the thing, right? What if I wanted to find some bull breakout trades? I want to find something that's squeezing to the upside. I want to look for any one of these. This is showing me where buyers and sellers can be. That's all it does. If there's the maximum order flow due to delta hedging right here, then you will likely see, if I'm a bull, for instance, the way you read this is if I'm a bull and markets in between here, an example here, if I'm a bull, I'm not a bull anywhere except for the one place I'm expecting buyers to be in what I see, which means against this yellow. It's the only place there's a green arrow, which means there's an abundance of activity expected here. Doesn't mean it should happen, but if it gets there and doesn't happen, then I know to get out of the way. And that's exactly what Rocket Skier is designed to do. Tell me to get out of the way. If I'm buying, there's nowhere else where bulls will manifest that I can tell. Came with these tools I did. My team, my background, I am a chemical engineer by degree. I used to work as a unit engineer at Dow Chemical back in the mid 2000s, where I went to trading. Taught myself how to code when I was like 12. It's captain of the math club all through high school. Kind of a total geek. Actually, do want a Celsius while I'm sitting here. I'm starting to nod off. I'm trying to do a new like cleanse thing, but maybe I should just make coffee. Let's see. Don't go anywhere. I'm going to wait, hold on. I'm gonna like go get me a drink really quick. Don't go anywhere yet. Guys, do me a favor, smash the like button. We got everybody sitting here this morning. Always coffee, yeah. Okay. I'm like, okay, I'll just get a Celsius today. So do you see how Oxy in that example that I'm providing is, as the market is trading between these two levels, if I were to long Oxy from here, my exit would likely bet that it doesn't break through there. So I will either cut all of it or trim. Usually I scalp between the yellow and blue lines. It's pretty solid. I love taking that trade. Like right at the open, you get the letters, and then I just come here and match it up. and I say, do I want a long or short? Well, I know it's sandwiched between these two as it's expected to do. If it breaks one side or the other is the unexpected thing. The unexpected thing typically flies really fast. So I try not to be part of the unexpected trade. Any questions you guys have? I came up with these tools over the years. The exploration I took, you know, my background clearly was very helpful to this. I have a great life story. Dude told us Nicole a bunch of it when we were traveling. We still are liking that, you know. That dating less a year, we still learn things about each other. So I was talking about college actually. I used to research for the head of the department, and I was a reaction engineer. It was a subspecialty of chemical. I used to write reaction rate models for this project that we did, and I was an undergrad research assistant for the head of the department, and we were on the project. The time the Clean Air Act in the mid 2000s required catalytic converters on diesel engines, which hadn't been invented yet. So we were part of this global research team where like tons and tons and tons of people were working on different parts of you know, this kind of race to do the parts, and we actually were one of the teams that designed the catalyst that goes inside of it. So I was a little lab bitch for that. So I have a pretty decently substantial pedigree and work I've done in especially modeling, mathematical modeling, and things like, you know, just, you know, a little variety of different things I did when I was younger. When I worked at Dow, I was an engineer, and I ran an acrylic acid monomer unit. So I used to chemical reactor with millions of variables. And I used to write code to analyze the data. I mean, very complex, and teaching myself the code when I was younger was actually really, really helpful for my career. But when I got into trading, it was just kind of like a new frontier, and designing something that made sense as an engineer is kind of my point I'm making, is that everything that I grabbed from a textbook or saw on YouTube, just out the door list, complete garbage. Like, people were showing me charts with like technical analysis on it. Immediately when people are showing me that, I'm just like, this makes absolutely no sense to somebody with any brains in their body. Why would you use past data to predict human behavior in the future? And I always make the joke, I was like, if you could do that, then your girlfriend probably wouldn't have dumped you. That one girlfriend that you lost when you fucked up. If you could predict why, you probably would have fixed it before it happened. But the joke is that you know, you can't predict human behavior with colorful lines. And I think that the idea for me to define something a little more substantial, for me, for risk management, took me on this journey to look into options. And options right now show me somebody's desire to have risk at a point in the future at a price. It tells you, literally, it's a crystal ball. I want to be 350 calls on SPY for next Friday. It tells me I'm a bull between now and next Friday at that level. And on Friday, I will be long at that level. And so that's a pretty good eye-opener to me to say, why is nobody doing this? And well, it's complex, right? The data is really hard to analyze. And I think most traders just get trapped into the simplicities of technical analysis, where it's like, here's a trend line and buy when it crosses over. You learn that in 5 minutes, and then you just practice that same elementary relationship and never spend a lot of time going into it. Plus, you know, traders aren't necessarily all going to have engineering degrees where they crave a little bit of complexity in their mathematical breakfast, right? So just took a little bit of a dive, and our group was started by 3 guys that were engineers. So we were going to take a different approach. It's cool you worked for 10 years in the muffler manufacturing at BASF. Was a company that coded the catalyst. Yeah, we got our catalyst from different places. BASF was one of the suppliers of us in our lab in Engelhard, I think was the other one. You did the wash coat coating on the monoliths, Blue Edge? Did I buy my monolith from you? Well, not mine, but the grad students. I was the lab bitch, remember? I was the undergrad. That's kind of really cool. Yeah, and also in college, I also was a student teacher. I taught fluid dynamics and material science engineering, which was a really dope ass class. It covered like the physics and chemistry of solids and conductive materials, superconductors, little things like that. They manufacture the muffler. Oh yeah, just welded and assembled. It's pretty cool, man. Yeah, we built a simulated diesel engine. Let's go back to QQQ now. We built the simulated diesel engine exhaust in the lab. So we basically had all those poisonous chemicals that come out of the exhaust of a car or of a truck. We had them all in bottles, and we blended them all together to create simulated exhaust. Oh yeah, SOx, NOx, everything was there. Sulfur dioxide, I mean, all the stuff that'll kill you. And I would measure gases absorbing onto the surface of this catalyst that we used. I had to walk around the lab in my socks because you were measuring weight change in picograms. They're so small. You're measuring like the weight of something as gases sticking to it, which is very, very, very small. But we had things that can measure that. Problem is, if you were sitting by the machine and you sneezed, the data would go, and if you walked around your footsteps, the data would catch it like a heartbeat. So it'd be very quiet. It was really neat. So liquidity map, Ollie, for which one? Things are good now. Okay, so another thing is, say that I want to look for some stocks that are breakouts early, and this is the best part of Rocket Scooter. If you guys can do me a favor, click that like button. Yeah, we're looking into it. There's it right here. You just have to refresh your platform. Ever since CBOE changed the options schedule, everybody that uses data provider is having issues with them. Problem is, they're one of the only people in town that provide what we need. So we just have to kind of deal until we fix it. But trust me, we're yelling at them while we fix it. It's just because, you know, CBOE has basically added 2 additional options to the schedule. So the data has gotten, you know, if you tit for tat, you have 3 different weekly expirations, right? Monday, Wednesday, Friday. Now we have Tuesday and Thursday to go with it. So, 66% increase in throughput of data pools. So they're obviously hitting a congestion since that happened. That went live on Tuesday, by the way, and that was an exchange change. But since we're on like the forefront of technology and these changes, obviously we're the world's guinea pig for that data provider, because nobody pulls data like we do to that degree at the moment the market opens. So we are their stress test. They literally tell us all the time. So you guys are a stress test. And I'm like emailing them. I say, hey, we have congestion. They're like, we were waiting to hear from you because we were wondering what you guys are going to say. We're a constant thorn in their side, but we are their favorite thorn in their side because they are forced to debottleneck their business model. Because we search for every stock the moment the market opens, and every option the moment the market opens, for stuff that nobody looks at because we need it for resilience. So we're like, turn the fire hose on, and we need that blast of data right now. So that's that. So it's a good thing and a bad thing. But the good thing is that, we're the first to have it when they fix it. We're that stress test, and everything's correct. It's just coming in slower. That's all. And so what we're doing is we're trying to do a specific series of steps to improve the experience. Let's just say that. Just refresh. What's up? Hey, yo, what up, Ashton? Good morning, my brother. So if I were to look for, say, something that was breaking out to the downside or breaking up to the upside, what I can do is I'll go to liquidity map right here. And I can say that these are types of plays that I want. Imagine the S&P is trading down on a BSU. We're losing hedge pressure, right? So if I can go to BSU and we are down in this area. There is no particular batch of liquidity. Sorry, no batch. There's no burst of buying from liquidity, right? Nothing in here except for the bottom and the lowest call on the zones. The only place I expect buyers in this setup, which means with SPY, that's really far, right? There is no place in here I'm going to be making any longs today. I'm actually contemplating adjusting my Qs and going out of the way. The only place that you will see buyers that's not on liquidity map is going to be the close price of yesterday. As resilience has been less than 0, this is forecasting that half gap in this redistribution zone. If we open here and we close here, the area between the two is called redistribution. So let me draw it really quick. Half gap pivots to here. It's predicting what the S&P is going to do relative to its own half gap, number one. So resilience is this white line. This white line is calculated in real time. So right out the door, right, resilience just goes negative right here, about right here. So it's a leading indicator. As it's negative, it's forecasting that this is resistance, even when it's above it. So you know that this is a fake bounce that you're not going to take. And then it's pressing its way lower. This is a forecasting tool. When the markets are rational, resilience is a leading indicator. Sometimes can lead by hours. It is an arbitrage measurement. So as you see, proof right here, at this point in time, at this point in time, at this point in time, that's where I'm drawing. Around here, somewhere in here. It's saying that it's going to fill the gap, or want to fill the gap towards the downside. And that's what you see. So if you have the movement from here to fill the gap, that's what's expected. So even here, when this is bouncing like this, this is not an area to buy because it's a BSU for me, not an area to buy. And BSU has below monthly hedge pressure. When you break through monthly hedge pressure, this is a bad sign for the day. There is no long opportunity from here for me until the lowest call wall in the zone to match the letters. There's no random buyers that are going to step in anywhere in here for any reason. All of them are getting squeezed today. Yes, I always use SPY res no matter what I'm trading. EQQ res is a formality that I rarely use because the SPY always pulls the NASDAQ. It's very rarely, if ever, the other way around. The NASDAQ is rallying, the SPY is crashing, the NASDAQ will crash. If SPY is crashing, the NASDAQ starts to rally. The SPY might show some signs of life, but the SPY will always do its own thing because it's more diversified. And it represents cash flow into equities in general because it's a diversified index. NASDAQ is not. As you see, calling it play-by-play like a sportscaster, there is that gap fill right there. The only place to expect to see buyers, right down here, well, actually not there yet. Right here at the close is this little spot right here where my mouse is. We are going exactly to there, and you will see activity when we get there. Promise you that. Watch for the volume spike when it gets there. So you're watching this in real time, right? So you're watching me announce this play-by-play. If you're just tuning in, this might be really neat for you. As the market goes here, I say we're going to fill the gap, and we're going to fill the gap. Market gets here, I say we're about to see a volume spike. As soon as you get to right here, you will see counter volume to that. It's not a buying opportunity for me. Yeah, maybe try logging all the way out and logging back in, Ollie. Sorry about your issues today, bud. The lowest call bar today is very, 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 very low. It's like, let's go here and SPY. 378. I mean, it goes pretty low. Actually, 368. So there is no expected support from liquidity map. It's either going to bounce here or it's bouncing nowhere. That's it. So in the redistribution zone, open and close pivot each other. With the resilience less than 0, then we know that half gap is resistance. Any upside from here to there is a 2-point move with a 1-point stop. So the only entry from here is a scalp from here to there with a 1-point stop. Being that there is a monthly hedge pressure break, class, everyone type in chat, what does that mean? That's one of our rules. That means something is irrational. Nailed it. So Irrational markets have this get out, stay out mentality where we don't try to chase anything. What is the opportunity I'm going to miss out? Well, I mean, you know that the market's going to overshoot pivots when markets are rational. We have a video that covers that. There are 5 checks that I do that can actually tell you and predict the market's going to be kind of shitty today. This is actually saying today is a good day just to go back to bed, right? Google's not doing too terrible. Like I said, I've got a very sizable position in Google and Qs. I've got, what, 3 weeks for them to play out. Not afraid of monthly expiration, but I don't like monthly hedge pressure breaks at all. So not my favorite thing in the world. Let's get that music back up. Okay, so let's play a game, right? I'm going to look for, now that the S&P has hit its pivot point, I'm going to look for some setups, right? This is how I use the scanner. So Rocket Scooter is a really awesome scanner on it. I'm going to use Rocket Scooter now to look for scalps that are either BLD or BRSU in between the hedge pressures. So what I do is I can actually now sort by the different things that I want. BLD or BRSU. Oops, sorry. BLD or BRSU. I don't have my glasses on. Everything's good. I'm going to search for those, and I'm going to look for things that that are between the 2 hedge pressures. So distance to hedge, right? TXN. So the S&P has hit where I think a bounce point will be. So the trick is, let's get something that hasn't moved yet. And here's a great example. On a long setup today, Texas Instruments, BLD from yellow to blue. BLD from yellow to blue is a scalp. So this is how I pick my plays. And I can sort by ones that are right next to those entry points, right? It's pretty sweet. So now I'm looking for something that can possibly scalp from here to here with a controlled reward to risk ratio. Y'all see that? Does everybody see how that works? Pretty neat, right? So while I might sit out on the SPY, I will know that I have particularly something that has that same potential burst where there could be volume to support the trade. And then I come in and I look for those opportunities. So like TXN would be one of them. The BLD, Visa example, similar setup. And they're going to be at the same place at the same time, which is really neat, right? So what I wanted to look for the short side and the same, my scanner would have popped Visa up from that yellow to blue on a BLD, which is this one. See, there's the scalp, yellow to blue. There's the yellow to blue. I mean, it's like clockwork every day. Review Oxy, yeah. You're guessing it's rare to see a break over MHP if it breaks once? Yes, it is rare to break and break again. You need catalyst or some massive event or something big to cause a break to break the other way. You need Wall Street to shuffle money one way, then shuffle it the other in mass. And typically doesn't happen. It's almost like a one-way street for a monthly hedge or hedge. Any of the hedge pressure breaks can cause a rapid squeeze. An example, this one, as you get there, it may not look like it because there's the opening volume shadowing it, but you can see that anytime you break through hedge pressure, there's always a volume spike as you're pushing through it. This right here is the volume, not this, not this, not this. And then the touch is the second volume. The idea that we have the first platform in the world, forget the look at my trend lines, let me predict where the price is going to bounce. How about from the moment the market opens, let me predict where your volume is going to be. This is a new paradigm of trading. This is a whole brand new thing. This is why you see us getting a lot of press lately, because people are really interested in the third type of analysis, while technical analysis attempts to predict where price action will be using former previous price at a time in the past, using price and time in the past to forecast price in the future at any time, which doesn't really do that. Your moving averages cross over. The only thing it tells you, right, is technical analysis, is price and time or what go into averages, right? Function of price and time. And the output is, it doesn't even predict where price is going to be. It actually, the output is, it should go the other direction. It's very weak as far as analysis goes. Well, it's overbought, oversold. It should go the other direction. Well, where will it go? Well, your averages aren't telling you which price it's going to be. So there's a very high limitation there. But the idea is that we have a time independent analysis now. People say, what's the best time frame to use? We no longer use time frame. Where's the multi-charts? Why do you need more than one chart? Well, what about confluence? What does that word mean? Oh, confluence. Confluence is where somebody sold you some technical analysis system, right? And it should work. But if it doesn't work on the 1 minute, go ahead and put the 5 minute on and then look at them together. And if it doesn't work there, put the 10 minute and 13 minute and the 80 minute and 200 minute and 400 minute charts. You get 90 charts on your screen. And then ultimately you can blend them together and give yourself a better view of the market, right? It's like one chart, no candles, no time. I don't even need a chart. It's just looking at price and volume. Our input is options information, price data now. We don't use historic price data. I don't even look at yesterday's price data, period. The trend, the monthly trend, the weekly trend, nothing. It's the opening price in the morning. That's the only thing that we need. Opening price in the morning. That's it. It's real-time liquidity analysis. And what we show you is not where markets should pivot at random points in the future with no ultimate stopping point. What we will show you is we will predict where volume will be at a price. Holding time constant, time independent. So what that means is that no matter what happens, I'm going to tell you there will be volume here and volume here. So what does that mean? Well, if I'm a trader, these are my 2 points of interest. It doesn't matter how many charts, what time frame, anything. I need to make sure if I'm doing something, I need to be paying attention here and here. If I'm shorting, well, there's a great op there. If I'm longing, there's a great op there. If I'm stopping, if I'm long, I don't want to be long down here. If I'm short, I don't want to be short up there, things like that, right? And it's just having the volume to come with you. So when you touch those particular areas, that volume starts to ramp up and volume starts to ramp up as you're moving through them. If I'm a bull, I need a surge of volume to come with me. How do we derive that volume is we're looking at a bunch of relationships. We have 15 different indicators that all predict volume at a price. They're all different. They all exploit different mechanical features of the exchange, mechanical features of what market makers are required to do by regulatory agencies, rules that market makers follow that the exchange give them just to get paid for their job. We exploit the things that you didn't think were possible, and we put them into a non-complex, easy to follow way of showing you where your volume will be. You've ever heard of any of these unusual volume, unusual activity programs that are very popular right now? And they're very good, not dogging on them. Tons of my friends use them. Tons of our guys use them as well. The difference between us and them is that we will tell you where that unusual volume will be from the start of the market. We don't wait for it to happen and then it flags and we're alerting you there's unusual volume now. We told you the minute the market opened where it will be. If you get there, 212.5 is where it's going to be. And all of a sudden, you're 20 minutes ahead of all the people you know using that stuff. You were waiting for it. And then like our people that use that kind of stuff as well in conjunction with what we have will use Rocket Scooter to map out their day. When you get there, you want that unusual volume to confirm your play. You still use the multi-time frame charts? Not Travis, you know I love you, bro. But the idea is that it's not a bad idea to use multi-time frame confluence for understanding greater sentiment. But here we go. We'll give you the daily sentiment and the monthly sentiment in one chart. So the idea is that we give you what your 8 different charts that look like the opening scene of The Empire Strikes Back. Giant neon colorful laser battle. As you're trying to make heads or tails of the market, here's your sentiment for this week. Here's your sentiment for this month. Here's your monthly volume. Here's your weekly volume. This is today's gap pivot from the imbalance between open and close. This is where the real bulls are and the real bears are, no matter what time frame. These bears are holding options that can expire at any point in time. There's a mix of all options that exist. So the idea is you can use multi-time frame but these pivots will be what they are. So whatever you're using to make your analysis, putting rocket scare on top of it will show you there's that volume that you're going to get. And so throw me a random ticker and I'll just prove to you what it is. I mean, you can't argue with what you see. So I'll show it to you live, and it's live, right? So I'll throw something up there that y'all pick, right? So it's not like pre-structured, like I'm showing you the best example, right? Ollie, go here. Market's irrational anyway, so I wouldn't panic. Go here, click default. And post a ticket in tech support. I'll see if the guys can help you. You know me, bud. I got you. I'll help you out as soon as I get off the stream. You want to use MU and Exxon? Okay. So MU. Like type up some So y'all want to do scanner settings today. If y'all come, everybody go to the Discord really quick. Go into the free trial. And today we're going to do advanced scanner settings. This is what everybody's been begging me to do. Matt, what are your secret scanner settings? Okay, so MU, BLD. Again, anytime you touch hedge pressure, volume spikes. Okay. Again, they're close to each other, but as you see, you're interacting with hedge pressure and hedge pressure. There's your volume spike. Breaking through it, there's another volume spike. Breaking through it, there's another volume spike. Do you guys see that? Can't argue with what you see. As you may think volume was random, you were seeing the maximum flux of order flow balancing the risk of sold options to market makers. And if it's not ringing a bell in your head, you should be saying, wait, how do you know where market maker options are? How do you know that? And the entire spectrum of what data comes through, how are you able to tell which ones are market makers and which ones are my 2000 YOLO Tesla calls for this Friday? That's our technology. We are able to understand the relationship of what constitutes. Our algorithm decides every trade that is made of every option that exists. That's why we cluster up our data provider, the same data providers that provide options data for all your favorite trading platforms. And why little old Rocket Scooter is congesting their server, because we look for every option of every stock. Stock number 499 and 500, the S&P. We're looking for their weekly options 4 weeks out, like, things like that. We're pulling so much data just to do these correlations. We analyze every single piece of data that comes through, and we actually have that relationship. We use a bunch of really clever techniques to do this. This is years and years of work. So if you guys like what we did, it's pretty cool. AMAT. Just showing you that the hedge pressures are where volume will be. And I mean, you're throwing random tickers at me, guys. I mean, can you not see? It becomes a pattern that you see. Wow, look at 108. Look at that 105. There's your pivots, right? Scalping. I scalp between yellow and blue all day long when I'm scalping. It's not, there's no Nobel Prize for trading. We do have a new economic theory, though. We call it the sum of least risk theory. It's a theory of efficient markets, where the markets tend to drive themselves to the maximum point of liquidity. You want me to teach you a little bit? I'll teach you guys a little bit of this. So let me get my handy dandy notebook here. Bull zone is where at some point in the past, somebody was long the market when there was no seller. Somebody was a bull way back here. So let's do an example. You guys ready for this? If you don't mind clicking that like button, really, I would love you all to death. Say that I longed the market, right, weeks ago. And I'm going to draw a price. Price is just going through the roof, and I decided to long. And I bought 1 million shares, and nobody was selling to me because everybody was buying on a big news catalyst. Market goes up. So obviously, somebody has to facilitate the other side of the trade. And they say, market maker. What's a market maker, right? They're an institution that signs up for this voluntary job they get paid for. Why do they do it? Well, they get paid to do it. They make a little bit extra money. If you have a lot of money at your disposal and you want to be a market maker and you sign up and you fit all the bill of what they need, you get paid to do the job. So as long as you go in and quote the bid and quote the ask at the same time, remember, you must submit an order at all times. Remember, you can go to the level 2, right, of any stock you're trading, and you can put an order on the bid. I'm going to buy 100 shares here. And you can sit back and see if it gets filled. Market makers are disallowed that flexibility to only trade one side of the market. They must quote both sides, and not only that, they must submit the order as a tandem order, which means when you submit your order, you get the option to, I'm going to long at this price and hit enter. They have no flexibility to long at a price. They must enter a tandem order, which requires 4 inputs. So they must submit their order and modify their order of all 4 inputs, which means they must long and short at the same time and quote both sides of the market, or else they get kicked out of the program if they don't follow the rules. Now, of course, it's all algorithmic at this point, but they're on both sides of the market, which means they have to sell. So they either want to sell higher as market raises price to look for sellers. If there's a lack of abundance of sellers, they're going to raise the price. If there's lack of abundance of buyers, they're going to lower their bid, and it's going to get wider. This is market making 101. So why do they do it, right? Because they get paid pennies on the dollar from those exchange fees and those commissions that you pay up the ladder. They get paid to do that. So as long as they get on the other side of your trade and they immediately zero out their risk, well, they're making free money, aren't they? So here's the thing. If I were to long right here where the market's rallying, right? Like weeks ago, I bought a bajillion shares at this exact level, 105. And forget everything you see on the screen right now, I'm just going to drop. And so there's nobody selling to me. So obviously that person quoting the sell side of the market was a buyer or seller of last resort. In this instance, they shorted to me and I longed. Okay, that's cool. And they shorted to me and they immediately took a counter trade to balance out that short. Market's rallying. Remember, in this example, market's rallying. Boom, 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 boom. Why is my drawing tool? There it goes. They're shorting against the market and market's rallying against them. Ugh, so they're always upside down, right? But if they hedge it with calls, which is what we're in this example, is the very simplest way to say it. If you understand how calls and puts work, if I long the shares and they short the shares and they buy calls in that stock and they weigh it appropriately at all times to delta, in this simple relationship, they have zero loss, because if the market goes up, the calls make money and they add to the position as it goes up. If the market goes down, they subtract to the position as it goes down. The calls will gain or lose as much as the short is gaining or losing, and they balance that act out all day long while trying to facilitate the other side of the trade. Essentially, they're looking for another seller to fit your other side of the trade, but in the meantime, you're just trading against the bank when there was no seller. So if we look for this type of activity and that type of volume, that delta hedging, as they're adding to the position while it's in the money and subtracting when it's out, you back into the people that sold those options to them and you get that big volume burst, which is the maximum amount of them adding or subtracting to their balancing act. Because delta congests very quickly near the money. If this is the option, just kind of showing that. You see how delta, the distance is big and small and small and small. The maximum change in delta is the maximum change in order flow at the money. So that's why you get maximum order flow at certain areas, because we take this relationship and look for all the options that exist. This is, I skipped a couple steps. I went through and skipped straight to hedge pressure, but if you can see the example, that's kind of what we're doing. First step is we find this relationship, we find these calls, and these calls imply that there was a bull with no bear. So the bull zone is where there are bulls with no bears against them. Bear zone is where there are bears with no bulls against them. It is a pure risk distribution of where the bulls and bears really are of the market, and the bank is trading between both of them. Do we all understand this? Do y'all like a concept like this? These are the real bulls of the market. 105 and 106. Anything below 104, there are no bulls. There's all bears with no buyers. Okay, so we find the options and then we check the relationship and then we reverse engineer where the longs were with no shorts. We find illiquidity, which means there's a buyer with no seller. Illiquidity, buyer with no seller. It's a one-sided market here. As you see in the bull zone, there is proof of buyers and you're seeing them right here. And so liquidity map is your way of mapping out where buyers and sellers are, because bull zone and bear zone are where buyers and sellers are. Somebody bought here and sold there. And most importantly, what we show you that nobody else has ever showed you is they're still in their position. So an example, yesterday markets rallying and rallying. See, my pencil thing is all slow here today. Markets all clustered and rallying. There's a lot of order flow and market rallies a little bit. You put a volume profile on here, the next day and the previous day will show, you know, like a little bit of a volume spike there. Okay, there's order flow right here. So clearly a volume profile is going to show you volume at price of the past though. And so if you were to return there, you know, it's in a technical sense, you know, when you learn volume pivots, one of the first things you learn is volume profile and VWAP, which are very, very strong. The one problem, thanks, Ollie. I got you, man. And like I said, we'll make sure we make it up to you guys. Yeah, we're growing really fast as well. I think we're growing way too fast. By the way, so we have a Black Friday special. If you guys like what we do and you want to see our platform, our scanner, everything, we are doing half off for life for people that want to join the monthly program. So you grandfather in, kind of like that gym that opens up down the street. Your first 1,000 members get in at a $100 price point when it's a $200 membership, and you can keep that for life and brag to your friends. Especially if we get new stuff in, like futures data, forex data, things like that. There's not gonna be no price raise for those of you to join. So if you want to join our program, $100 is like a couple books at a bookstore or a dinner at sushi one night. Actually, no, that's like half a dinner at sushi. Give it a shot. You may like it. We train on 14 unique indicators to predict volume, and we teach you layers of the market that you never thought existed. And the difference between this and actually, let me go back to what I was drawing, and other types of analysis is that it's completely unique, right? If you're shopping, you have a technical system that you're looking at. Okay, I mean, technical analysis, I know I dog it because I think it's just really bad mathematically. It doesn't mean it doesn't have its merits if you're used to using it. But the difference is that there's a million of them out there and they're all exactly the same. It's all technical analysis, and technical analysis is no different. People just mix and blend their indicators differently to try to expect a different conclusion. In reality, it's like the only way to get something completely different from technicals, like, is to use fundamentals. Macroeconomics, microeconomics are going to give you something that your trends on your chart are going to tell you. Moving averages are crossing over, but the company just fired their CEO because he got caught in the backseat of a limo with a hooker or whatever. There's a story of that at one point. That's even inappropriate. That's not even politically correct to say. A lady or man of the night could be a man. You never know. And then they get fired and the company's tanking. So what happens is that has nothing to do with the charts. It's completely independent. It is a one-off event that's weird that you didn't expect, and your trend line certainly couldn't forecast, right? You know what happened to Robert Downey Jr. actually back in the day? Wasn't he in trouble for something? He's one of my favorite people in Hollywood, though. He's a cool dude. People say I look like him sometimes. I don't know. I wish I looked like him sometimes. What up, Maddie B? So, so the idea is that to get completely different side of the coin that's not technicals is fundamentals, right? They're so radically different. There is zero overlap between the two. So what Rocket Scooter is a third thing that has zero overlap between anything else. Because the output of technicals is using price to forecast pivots in price. Fundamentals is using the health of the company or health of the economy to forecast potential longer term changes in direction. We are going to show you where volume is at a price. So we show you something that does not overlap. It's not even close to overlapping. So having a third layer of your analysis is completely really revolutionary. Not somebody takes one indicator or 1,000 indicators and blends them together and says it's revolutionary. It's really not. It's just giving you more depth to something that's already there. Revolution is something completely different. So you can say, all right, I'm going to use my technical system. Here's a crossover here. I'm going to use my unusual order flow thing that says right when those crossovers happen, my unusual thing is going ding, 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 ding. Okay, so unusual flow. Rocket Scooter also said there should have been volume there from the beginning of the day, and there is a balance, and there's unusual flow, and my averages crossed over. Well, that's what I'm talking about confluence, right? Confluence is not adding 90 different additional colorful pictures to your chart or indicators, it's adding a different layer to something you didn't see. Rock Scooter says there should be volume. Unusual Whales said there is unusual volume when we got there, or black box stocks. Like, all these programs are really good, by the way, at what they do. Tons of friends over in the unusual side of the world. Some of my favorite traders, actually, like if you guys know Mel Stone over at Black Box. I'm like Mel Stone's biggest fan. Oh, show. So you say there's shows there's unusual activity. Rock Scooter said that's where it should be, and they confirmed it. And all of a sudden, you bounce off a VWAP. So now you've got strong confluence, right? You got tons of techniques that are giving you better confluence than I use moving averages of 8 different time frames, and I'm using a MACD, which is just a fancier way of doing moving averages. And then I'm looking at like the shape of the pattern and things like that. You're gonna have a better time understanding more depth of the market when you spread out what you're looking at and you look at something from different angles, completely different angles. So we wanted to do something that was just like this. So back to like teaching what liquidity map is going to show you guys is that bull zone is where there are bulls with no bears. Bear zone is where bears with no bulls. Hedge pressure is a net order flow increase just due to market makers hedging their stuff. There are the two volume spikes. You can see them right here. At the top, right here. At the bottom, right here. Volume unusual 1, unusual 2, and they sit there at the beginning of the day. And it is pivoting so razor sharp. It's beautiful. Doesn't mean it has to pivot there. Remember, this is not suggestion to buy or sell anything. But what it means is if the market's floating in here, class, would you guys buy or sell randomly in the middle? If I'm going to say, okay, I wanted to long this, and it starts to do this, would I chase that long? If this is where it opened and it's doing like this, would I chase that long right here? Fear of missing out. Oh crap, it's broken up to highs of the day. FOMO, I'm going to miss out. I got to long this. I'm going to miss out. No, right? It hits this and start to sell. Ooh, I need to short this. I'm going to miss out. Well, you've now chased the long at the top and chased the short at the bottom, potentially. No, you can't predict the stock market. So it's just bad risk to reward. So now what you have is a way to do risk and reward in real time, which is great to me. Market's doing this. I want a long. I can tell myself, ooh. Here, small reward, big risk. If I do chase it, it's going to be a small position, right? Rule of thumb, your reward to risk ratio. The lesser it is, and a better way to draw that, but smaller positions, small. The greater, large. Very simple. If you know your risk and reward, well, how do you know risk and reward with trend lines? You don't. Because trend lines just say it should pivot. Okay, so it's telling you there's a direction, but where? Where does it go to? And I mean, the trend lines crossed over. They're not going to tell me when it's where it's going until they cross back over in real time. So you can't plan it out. You have to react when it happens. So the technical analysis people are like, you got to trade it. You got to watch it and stare at it and stare at it and stare at it. And you can't take your eyes off of it. And you can't even move your mouse from it. You got to have your mouse literally on the button just in case it crosses over. Watch it and focus. And it's like you can't plan against that. You're literally just playing the market like it's a game of Galaga. You're like watching the spaceships as they fly by, and you have to click the button. Like, you can't do that and plan. You can't plan where the crossover is going to happen, right? So in that sense, you can't plan ahead of time. So the one downside, again, everything has correction. As an engineer, I see a hole and I say, okay, let's try to find something that can help. So as the market is trading here, or this stock is, and it falls to there, I can immediately say, if I long and if I get volume support and the volume spikes and decays and I'm still on the right side of hedge pressure, good. Then I can long from here to where I expect sellers to be. Even though it may continue to go and break, I expect sellers to be there. So my trade is going to be planned to go there at minimum 3 points. And I could put a 1 point stop on the other side of hedge pressure. It's a 3-to-1 trade from here just to there. And lack of better explanation, that's a quick and dirty way to say risk management. Now, if I'm expecting volume to spike here, and that volume does spike, however, when that volume declines around this side, it's the decline of volume. If you're on the other side, the market tends to go in the other direction. So the trick with volume pivots, as most people have been taught incorrectly, it's not the volume spike you're looking for. The volume spike confirms that you have the right pivot. It's when the volume's decaying, what side are you on? Because above hedge pressure, there's just a net flux of long orders being greater than short orders, just a delta hedge. This is just what that means. So imagine prices falling, prices falling, prices falling. Volume is like normal and volume is normal. And you get right up to there with all those deltas start showing all that maximum order flow, and you get right here in volume, all of a sudden it goes, big volume spike is all, and that's a mix of longs and shorts. So it's like telling you where the battle is going to be, right? And there's the battle. Long, short, long, short, long, short. And this should slightly outpace this. Slightly. I'm talking like slightly. It's just enough, though, that when that volume declines, whatever side of the fence you were on, when this volume starts to decay out, then the market just stays on autopilot and there's no counter pressure to push against it, and it slowly starts to drift up. It's exactly how you read volume pivots. The right way. Does that make sense? It's not the volume spike that you need, it's the volume spike says that was the right pivot. And when the volume goes away, which side are you on? So if the volume starts to decline and you're trading like this, and all of a sudden you get another volume spike and the market comes like this and goes like that, volume decays down again, then you're going to start to drift this way and speed up. Oh yeah. Okay, so Black Friday special for Lifetime membership. Yeah, no problem. It is. Yeah, we'd love for you guys to support us. Our goal is to create tools that predict and show where volume will be, so that a trader has a new layer of the market they've never had before. There you go, hand in hand with technical analysis can replace it. The idea is that you're now trading with a little bit more plan in your hand than just winging it. So nothing can predict the stock market, and we don't even though you look at this and people look at this and say, wow, that is hella cool. You have some letters, let's just match the letters, and the letters have arrows that go from yellow to blue and blue to yellow, and wow, you guys have a crystal ball. And even though it looks like it, we still don't say that. The stock market is just unpredictable, and the less reason for something to happen, no catalyst, no news, no event, you just show that the mechanical part of hedging is in reality the majority of all activity in the stock market. There's nobody really here. It's like what you're staring at, you may think, ooh, there's a bunch of bears and a bunch of bulls. No, actually, everybody probably took the day off. You're just watching the algorithmic ebb and flow of hedging. It's not really bears and bulls here today. The less human interaction, the more predictable the market can be. So part of the goal is we wake up in the morning and we decide if the market's rational or irrational. Rational means, and you guys can watch this video, it's really cool. We have a bunch of them on YouTube. And rational basically means the market makers have an easy time finding liquidity. Buyers and sellers. That video will show you about it. And markets are irrational, then I don't expect there to be a lot of stability or even predictability to the markets in general. But if you guys see what I'm showing you, pretty cool, right? Lights are going and the machines are making noise, but nothing's happening. Like you walk in, it's an empty room, right? Love Rock's here. Thank you, Charles. Love you too. Like running across the middle of a war zone, right? Isn't that crazy? You just... So the merits of what it is, you guys are buying a set of tools that are going to predict where volume will be. It doesn't matter if it pivots there or not. You know that that's the area of interest. The market's not going to randomly rally and no place for no reason, but at least I know sellers will be there and buyers will be there. How much? Well, you don't know. But what I do know is that when I go back to that volume profile example that I showed you earlier, what's neat is that if I use the bull zone as an example today, the bull zone was where I longed and there was no seller, and so a dealer had to come in and short to me with a call, okay? And they bought calls exactly here. Hold on one second. Oh, it's our data, guys. Hold on. I'm muted, guys. I'm on the phone. Wow. Okay. All right. So we finally got our call in of what we think is going on here. So it's not a delay in them providing the data to us. That is completely an indexing problem. They're failing on something I'm happy because it's fixable very quickly. What happens is they're timing out because they're dropping, like, they're not sending us. I can't explain it without explaining it. I think of a good way to say this. It's very easily fixable. It's not data congestion. That's good. That's good because that's a huge problem that they'd have and it'd take a long time to solve. What it is that they're not giving us the right symbol names for the options. That's for right. Example, if I want to look at SPY options, SPY 400 calls for a certain date, there's a string, SPY 400, C, this date, this date, this date. There's a certain string. And we generate that list of strings in the morning for market opens. And since the dates have shifted on those CBOE options, they're not returning us the symbols that we need to call. So we're just waiting, and then finally they kick us out the right stuff. So they're having a problem generating Like if I say SPY and they're like, okay, well, here's a list of all the SPY options we have. SPY 400 call at this date. And then 401 call at that date, 402, 403 at that date, and then the next date, next date, next date. All those strings that you need to connect to and get your data feeds for every option sliders. You guys have seen them, right? You ever seen like an options ladder with your calls on one side, your puts on the other, and you have all the options listed and all the Greeks listed and everything. Each one of those options has a unique ID, and they're failing on providing the correct IDs for some of them. And we're calculating it at razor sharp speed with no bottleneck, which is good. We're sitting there waiting. Where's the rest of the symbols? And so that phone call was from one of my teammates, the ones that run our black box in our data pull center. So, like, we got done analyzing the data, and don't worry, it's not us, and it's not you. Like, it's good to know. I'm going to type this to my team really quick, and then we're going to get on it. 1 second. Most importantly, what is this music channel? It is called No Copyright House Music for Streams. I don't know, something like that. That's exactly what it is. Database indexing, dude. How to calculate half gap using classic app? No. Half gap is calculated. It's the halfway point between open and close. So you don't need any app. You just close, open, halfway point. Okay. They'll make a couple more tickers, you guys. And I'll get back to that example. So yeah, things are looking pretty nice. I think this is a fixable problem if they can get their indexing right. So essentially the new dates ruin their entire system. Can I make a guess that they didn't even adjust for this? But they didn't adjust for this, and they're having a systemic error on this. Like, they didn't adjust anything on their end for these new dates. But what they do is they parse the raw data feed into usable feed for people like us. But I bet you they didn't fix it, or they are fixing it. It's just such an infrastructure change. When CBOE makes that announcement, it just takes them weeks to adjust, and that could also be the case. I'd hate to blame or accuse for incompetence. I'd like to say, I know as a software developer myself, it takes a while. So if they get that announcement last week, it's not like, okay, we'll have the change done tomorrow. It's probably like, let's build a robust system and do it. But the problem is we don't get an email that says, hey, by the way, things are gonna be a little sluggish for a couple days or weeks. It's just like, deal. And the problem is that nobody probably notices except for, us, because we're the group that, goes to every corner of the warehouse and looks for every option at every time, when most people are just looking for the main shit at the market open. So typically in your software use or your user base, your carryover time of continuous improvement development is blended in the fact that you just expect nobody to notice, right? Like, it smells funny over here in the corner of the room. Well, let's just keep the party on this side for a couple hours till it clears out. Nobody will notice. I dropped a big fat fart over there in the corner, right? We notice. So maybe we're the only one with the problem. But at the end of the day, they likely should be, hopefully be fixing it. So we're building up an email for them. Half of that phone call was actually him asking for a new NDA because there's a new person on the team, database specialist. So, yeah. Okay. A couple more tickers you guys want to look at. GME, yeah, Edict, let's go. GME. So the idea I was saying earlier about volume profile is that volume profile will show you where volume was yesterday, and it can't, you know, as a good indication of where volume maybe could be today or support and resistance could be today. It's not a guarantee. If I longed, here's an example with GameStop, just see really quick. Like if I longed right here at 27 and market makers were shorting with calls to me, they're shorting to me because I bought and there was no seller. So those calls are there. So what if I bought yesterday and I bought and bought and bought, and at the end of the day, I closed out my trade and I'm no longer in the trade. If I close out my trade, yet I provided all this volume here, then the volume profile will show that there's volume. I don't know why this is just not drawing. It shows that there will be volume there. But if I close out at the end of the day and then price is trading lower and I get there, usually you'd say, ah, there's a buyer there, so there could be other buyers there. But I close out the trade, so there really isn't a buyer there anymore. How would you know if they close out their position? Well, so Rock is here to tell you that too. This is supposed to be a call. If I wake up today and these calls are gone, that's no longer there, then I've closed my trade, so therefore that's not support anymore. So if somebody is bullish and closes out, your volume profile just shows you where they were battling, not where they are long or short anymore. You may misinterpret this as, ah, there's bulls there. Well, no, they close out for profit. There are no bulls there. So the lack of the calls means the lack of the bulls. And so we correct the problems in volume profile where sometimes it pivots, sometimes it doesn't. And that's another thing to note too. Okay. That was the whole takeaway there. I'll do monthly map and I'll do scanner. Everybody go to the Discord right now. We're going to do a big session today. Irrational market. No reason to do much. Let the market do its thing. We're going to have a pretty big session today. So everybody go there, and about 15 minutes to take a break, and then we'll have a little bit of a... We'll have a little bit of a session with our team. Oh, I got to reinstall something. And we do our educational sessions in Zoom. Looking at GME really quick. How to find ES futures on the Scooter app. You use SPY for anything related to the S&P. And the S&P, the SPX futures will all pivot at the same place. Yeah, you think there's support, but there's not, as Garrett is saying. Yeah, that's the whole point. So, monthly map for GME. Yeah. And somebody said, can we look at GME? You wouldn't take costs or BLU until you got past half gap since really is negative. Okay. So let's talk about resilience really quick. Resilience is going to showcase what the index is doing. Resilience is just to trade the index. Now let's do a little bit of analysis. But I use resilience to trade other stocks? Well, yes, but you have to understand what it's telling you. So let's start off of yesterday, or 2 days ago, we had advanced resilience training, right? If the resilience is less than 0, what does that tell you about the S&P, just in general? If resilience is less than 0, and we are still inside the redistribution zone, barely. See, we're again, there's that volume right here at close price. But say that we're in the redistribution zone, what does resilience less than 0 actually tell me about the S&P's maximum upside potential today? Yeah, it'll be in announcements, probably. Yeah. Or live stream link, yeah. Right, with resilience less than 0, it tells you that the S&P can go from 394 to about 396 and be resistance in the best way it can, right? Yeah, and more stocks are being sold. So GameStop could very much be on the other side of the coin of stocks that aren't being sold. But you have to say that if something is tethered to the S&P with no catalyst, right? If the S&P is just in a certain look and that stock is in a certain look, okay, then let's look at the arbitrage between S&P and that stock. S&P could possibly move back to about where it was at 945 at best with resilience less than 0. So if GameStop has the same look or even the same liquidity map, is GameStop doing that same, like a little H-shaped pattern? Yeah, kind of, right? Then if the S&P goes back up to where it was at about that same point in time, then GameStop also can go to that same point in time. So the S&P has a lot of room to go, which means yes, GameStop could also move as well. So I use this to say how far could the S&P move, and is this tethered to the S&P? Well, yeah, they look exactly the same, even though it's a different liquidity map. So let's pull it up and see what's possible. So the S&P can move pretty far, you know, maybe like 0.2% it looks like. And, you know, with GameStop, it's 0.2%. It's probably about right there, give or take. BSU sandwiched between these two, and yellow to blue are pretty much right on top of each other. It's not much of a run. And if it goes and kind of jumps around through here, I know the S&P has a limited upside that's not going to break the high of the day. So I'm not going to expect GameStop to break the high of the day either, while resilience is less than 0. So I can now start making further inferences about it. Even though resilience is slightly negative, it doesn't mean that everything has to be selling off. There's obviously some stocks that aren't. So if GameStop is in the boat that it's broken through hedge pressure and is irrational, just like the S&P, it looks exactly like the S&P. So it's going to trade very similarly to the S&P. It's irrational. I'm not taking any longs because there's an upside limit to whatever resistance it's likely going to have. So the S&P is going to be limited by resilience, and GameStop's probably not going to break through hedge pressure unless resilience goes positive. Because if resilience going positive would give S&P the boost to go forward to break highs, then that's the boost that'll give GameStop to go forward and break highs as well. You see how that works? So it's not directly correlated because the resilience is the index only. So if resilience is negative and Apple had earnings and Apple's way up, resilience is superseded by individual stock catalyst and reasons for something to move. But if everything's ebbing and flowing together, the S&P's distance that it can travel, you can mirror that same distance and those same relatively similar pivots at that same point in time. And as you see, I wouldn't be taking a long on GameStop because number one, it's got its own hedge pressure to resist against. And number two, if GameStop moves to here, S&P is likely to move to its half gap, which is relatively in the vicinity of below highs of the day anyways. So even the best case move on the SPY, while resilience is negative, GameStop only goes to about right inside of there and doesn't break highs. Does that make sense, Edict? So I use it as a way to forecast what a stock could do if the stock is tethered to the S&P, meaning the S&P is looking just like this. Now, if they have the same liquidity map, even better, but they have different liquidity maps, but you see that they look exactly the same. While GameStop is a BSU. So you can make like a, you know, you can use it cleverly like that, but it's not, resilience is less than 0, so GameStop has to sell off. Resilience is close to 0 and low, but there's plenty of stocks that aren't selling off. Like Apple's not selling off. JP gapped and is pulling back, but JP is still a gap and go, right? SPY is also BSU. So you can see that the correlation for SPY and GameStop are similar and the liquidity map is similar. So this is a very solid case that you can use them together, right? SPY is limited upside in the BSU and it broke the monthly hedge. You wouldn't trade SPY in this condition until you found a support. So you tell yourself, oh, the SPY is probably going to fall. They're exactly the same. GameStop broke their monthly hedge and S&P is likely to fall. So maybe I might not take that GameStop pivot I wanted until the S&P bottoms out, right? And so if they correlate, and especially if they have the same liquidity map, and especially if they're the same conditions, then yeah, then resilience can be very much used to pivot the stock. Because it's going to pivot the SPY. Does that make sense? Half gap resistance to the upside. Yeah, and that's what it means. And inside of the redistribution zone. Now, here's the problem, right? We're outside of the redistribution zone because we are in the Here's the close price, the open price. Outside of the redistribution zone is even worse. If you were down here, then if resilience is negative, then the max upside you get is yesterday's close outside the redistribution zone. So redistribution zone is between the close and open. Outside is not good. If res is less than 0 and we get that volume spike and we are trading against yesterday's close as resistance, there's your mechanics for a market crash for today. So be very careful and watch that VIX. Okay, we're going to go to our Discord and have a couple hours of session. Thanks for tuning in. Thanks for liking the stream. We love you guys. Biggest stream we've ever had. It gets bigger every day. If you like what we did, what we've made, feel free to check our Rocket Scooter. No credit card required. Free trial. Play with it for a month. Add some volume to your diet. Wheaties for your brain. You thought liquidity map and hedge pressures were cool, maybe resilience as well. That's 3 of 15 indicators. We have 15 now. I've been saying 14 for a while, but Doomsday is used in 2 different applications. Doomsday Band, Doomsday Pivot. So it's 15. They all predict volume. We will show you how they all work today. We'll go through a bunch of them. We love you guys, and we will see y'all on the flip side or in 30 minutes if you'd like to come to the sessions. Free trial. Go to the Discord. Link is in the description below, and we'll go through some stuff tomorrow. We love you guys. See y'all later. No moves for me today. Irrational market, letting it fall. Didn't dump my swings yet, even though I don't like them. I typically gauge the stock market after monthly expiration. So Monday, I'll have my answer of what I want to do. No hedging over the weekend for me. I'm just going to let it do its thing. I'm still way up on my longs, so I'm not in any hurry to what's out to ban the position just yet on monthly expiring mechanics, but we'll see. See you guys in about 30 minutes. Go to the Discord, hang out, get familiar, watch the videos. Watch some videos if you want. But we'll see a link posted for you in about 30 minutes, and we will see y'all there. That is best session we have. The ones in Zoom. Love y'all.